Welcome back to another Stock Market Open live stream. Today we are looking for PCE data. Now this data report is interesting because it should already be calculatable, and I think that's probably why stocks are somewhat happy right now. Mostly because it's based off of pieces of PPI and CPI, which we've already gotten. We've already gotten those surveys and reports. So we think that PCE should be quite understandable as, a pretty benign read here, pretty basic report. So I mean, hopefully that's the case here. But let's get into it. So this is it is Friday, 5:29 a.m. We get our PCE now. We're going to start with personal income. We're looking for 0.2%, looking for personal spending to come up 0.5%, looking for real personal spending, which is just GDP, or inflation adjusted at 0.3%. Then we're looking for the PCE price index. That one's somewhat important. Month over month, 0.2. Core month over month, 0.2. And year over year, 2.5. And then core, 2.7. So really, when you hear the personal income, month over month and month over month numbers, you're mostly just looking for 0.2s, except for personal spending, which is expected to be 0.5. So let's see what we get. I think it'll probably just match expectations or be low. I'm really not expecting this to be high because we've already had the CPI and PPI report, which again are the foundational data points for this. All right, here we go. Still not okay. Personal income comes in at 0.3, which is higher than expected. That's good though. Price index 0.2 and core price index 0.2. It's good on both sides of month over month. It's good. Core year over year actually comes in lower than expected, which is also good. We were looking for 2.7. We got 2.6. So this is a good read. You got higher income. You got higher spending. Real personal spending comes in at 0.4 versus 0.3 in July. That's actually pretty good, especially since July was supposed to be that month where the consumer was starting to turn around and go a little oopsie doopsies or something. So not bad. Not a surprise that we're getting a bit of a green candle here. PCE inflation report. I'm going to pull up the detailed report. Let's listen to Rick in the meantime for a moment.
You have to go to December of last year. Now, let's look at that PCE index month over month. Up 0.2 exactly as expected. However, it is a little warmer than the up 0.1 in the rear view mirror. And if you look back towards April, it was up 0.3. Now, let's look at price index year over year, expected to be up 2.5. It is up 2.5, and it equals last month at 2.5. And all these 2.5s happen to be the lowest level since February of 21, and it remains that way, of course, because it was the same as last month. And if we look at now the core PCE, we'll start for the month over month, up 0.2 as expected.
Yeah, at this point, we're just reading the same thing. So let's go right here now that I have it up. Personal income's increased 0.3%. We read that. Personal disposable income up 0.3. We've got, excluding food and energy, price index increased 0.2%. Okay. Let's see here. Prices from the preceding month up 0.2. Prices for goods decreased by less than 0.1%. Okay, so prices for goods actually fell. And prices for services increased 0.2%. Food prices increased 0.2%. And energy prices increased by less than 0.1%. Excluding food and energy, we're at 0.2%. Okay, got it. We'll get some details here on prices to see where some of these prices came in a little hotter. And waiting for this to load. Come on. Well, later today, we do end up getting UMISH data, so that'll be interesting. See the Q's basically stable here, not really moving in any direction. I think this is honestly mostly expected, this data. As I was saying, I think you're looking at data that's pretty much already built into CPI and PPI, and they sort of extract the items that they need to come up with this quote-unquote Fed preferred gauge. I don't know. I sometimes think it's a little loony that it seems like we have a whole nother report to go through, but it is. Okay, so, oh, here we go. Okay, there we go. Personal consumption expenditures by type and product. Okay, it'd be nice to get this. Ooh, they made like a whole interactive section here. How cool. Look at this. I don't know if I just haven't seen this before. New autos, new trucks. See, look at that. I can just tires and just throw stuff on here. Recreational goods. That's kind of cool. Food and bev. I could kind of click on and click off things. I like that. Used autos. Oh, look at that. Yeah, if you just leave one on, it makes it a little easier to look at. How about, let's look at, oh, I don't know, owner-occupied properties. Oh. So this would be like your, what, owner's equivalent rents? Tenant-occupied. Oh, it's straight up. How about outpatient services? Oh, it's straight up. That's not good. Water transportation. I didn't even know they tracked water transportation. Okay. Oh, interesting. Not bad. All right. Briefly listen in here.
I mean, you have also pretty much record profits in the private sector, and it seems as if, while yes, no doubt about it, people are still anchored to the higher price levels right now. If we get Fed rate cuts, if that seems like it could refresh some buying power in, let's say, the housing market as mortgage rates come down, do you think that we're not going to be able to sand off some of the edges there, Derek?
Overall, I'd say it's encouraging. Certainly looks better than it did 6 months ago. But we have to remember that the American people are seeing those persistently high prices. They're not going to come down. We all know that. And we have, slightly above target still at 2.5%, 2.6%. And so you have to see that in the context of it, that the economy is doing okay, but you've got American people that are hurting out there. We've seen that with the credit card data. We're seeing people that are spending money that they don't have on things that they have to have: groceries, gas, and rent.
Yeah, David, I guess this is the big question now. I mean, the soft landing premise has been obviously not confirmed, but it's certainly not been refuted by the numbers coming in. You have to test it at all times. The consumer side of things, the employment side of things, really kind of eye of the beholder right now as to whether it's hanging steady or is eroding. How does it look to you?
No, I think, first of all, if you had asked me 18 months ago what I expected, it would not look anything like this. So I think this is pretty damn good. 3% growth in the second quarter, inflation gradually coming down as supply chain conditions ease. For many people, wages now rising faster than inflation. So we maybe don't have a soft landing, but we're certainly approaching the runway. So I don't think that's in the eye of the beholder. It is true, of course, that people's perceptions are, as Derek said, and prices are higher than they were before the pandemic, and that's true. And economists like to look at their real wages and adjust for prices, and people don't tend to do that. But I think the concern now is the Fed moving too slowly? There are some signs of erosion in the labor market. The Conference Board data this week on people who say jobs are hard to get is moving in the wrong direction. Still looks pretty good, but the trend is not our friend. Unemployment has risen, and if it keeps rising, that could be a harbinger of things to come. So I think what we have to worry about now, we're in a good place right now. The question is, where do we go from here? Can we continue strong growth?
Well, I mean, I think this is pretty redundant, but interesting phrase to suggest, oh, we're heading towards the runway. Okay. Well, I'm kind of curious why the market seems a little poopy-doopy there. It seems like we got pretty decent data there along expectations. It's almost like it's tough to keep this market satisfied right now. I find that somewhat surprising. And it's somewhat evidenced by what we saw last night. I'm sure you noticed that, well, I guess it wasn't last night. It was more like yesterday afternoon. But yesterday afternoon, we were just sitting here at this line, the 476 line. And then all of a sudden, it's like somebody just gave the market a beating here. We went down to 469. We lost 7 points on the Qs in really just a span of about an hour, really. So kind of surprising. So I don't know, weird, pretty weird. You'd expect to see a little bit more of a movement here on. I mean, I think the market mostly priced in the what's it called? The release of PCE, because again, you get that CPI, PPI heads up, but still a little bizarre to see a pop and then a sell down here. Who knows? Once we actually get to market open, we'll get a little bit more color on how on the direction these things end up moving. We'll briefly listen here, and then we'll go to Doomberg.
One big aisle of it, and as far as how wonderful the economy's doing, listen, first of all, rates are starting to creep up as we're talking because, we largely have avoided talking about income and spending. Those numbers were pretty good. You blur your eyes, it's hard to see recession there. The second thing is, I think, David,
True.
And by the way, David, I've been reading your stuff and listening to you for so many years when you were at the Wall Street Journal. It's nice to be on with you. But real wages might have caught up lately, but they didn't catch up when we were at 9.1%. And as Derek pointed out, the problem is inflation rates have come down, prices have not. Think about wages, okay? Everything's still more expensive, but your wages didn't keep up on the front. They're keeping up on the back. But that doesn't matter so much. You're still not really ahead of the game. And we talk about economists tinkering with real wage numbers. What Brian and I see are real people dealing with it with their wallet. And trust me, the high prices aren't going to go away until we start to see about 10 months in a row of actual minus signs on CPI or some of these data points.
I don't think,
and I truly
Rick,
don't think we will.
want, David, I don't think we want that. I don't think we want deflation, right? Prices going down, deflation. That's a bad thing.
We never had it in the 80s. We never got back to the pre-hyperinflation numbers.
Especially when you're in debt, Brian. When you're in debt, almost $2 trillion on the budget, 35 plus trillion that we're carrying along. Oh, most definitely. The best way to get out of it's growth and inflation. So you're spot on.
Fair enough. And Derek, I would say this, that listen, and I hear it from people, and I've been on the tape on Twitter, X, whatever you want to call it. I think the home insurance crisis is going to be the kind of maybe not a black swan, but a gray swan, because there's nothing the Federal Reserve can do about somebody paying 43% more for their home insurance or 40% more for their car insurance. That's what's happening all across America. It's only going to get worse. And I don't know what Jay Powell can do to bring down somebody's car insurance rate.
You're exactly right.
You're absolutely
Derek first, then David, comment, please.
I mean, you're exactly right. The average family has taken about an $8,000 hit when you take both inflation and higher interest rates into effect. People are still feeling that. And what worries me even more is you have Harris, who has decided that she's going to adopt the Biden budget proposals for a whole series of tax increases. You have taxes on unrealized capital gains. I don't think many of us think that's the right way to go. You have highest tax rate could go to 44.6% on long-term capital gains and dividends. And you have a corporate tax rate that they want to boost ahead of China, above China, and you want to see way above the global average. So I think these tax increase potential also could be another big drag on the productive side of the economy.
David?
Well, two things. One is, I'm not sure that the Trump tariffs are any great boon to growth either. I mean, we have two candidates who are throwing around lots of ideas.
Now we're just turning into like a little political debate here about Harris versus Trump. Let's pull off this for a moment. I want to look at, here's the savings rate. It is true, yeah, Zero Hedge is somewhat freaking out over this. Personal savings rate was 2.9% in July, and if we chart this, we can go to, it'll drop below this, but this is the update from last month. And so you can see we sit over here now at 2.9. 2.9 is the lowest we've had since June of 22. Kind of crazy, but June of 22 was the low in the personal savings rate. And we hadn't seen a savings rate that low since basically 2007, which I always hate when I look at data and I'm like, oh, this is a lot like 2007. And then people are like, don't worry, Kevin, this time is different. Oh, no. No. So let's take a look here. This is the personal savings rate zoomed in, and you can actually see it sort of drug along the bottom for quite a while, actually. I mean, the personal savings rate was miserable from January of 2005, which was still boom time, right? Really until the recession. You weren't actually in the recession until the personal savings rate ironically rose. So, I think the recession is just not mega close yet. But it probably means, just based on the data that we're getting lately, it probably means you're closer to like Q1, Q2 for being more nervous about that. Which let's see, personal savings rate. Our personal savings rate, in fairness, has been dragging along the bottom since May of 22. So May of 22 would be about 2 years. And 2 years back here, July 2005, puts you about July 2007. Yeah, you've been kind of dragging around the bottom around the same kind of 2 years. Or you could go Feb 2005 here. Feb 05. March 22. Yeah, it's like 2.5 years you're dragging along the bottom. And you kind of had that here as well. Go 2.5 years after Feb of 05. Will put you at 8 of 07 here. Yeah, you still had, before the technical recession began. Oh, December. No way. Wait, is that just like a line in a weird, eerie way? Hold on a sec. What? We started from March over here, because that's when we get down to 3.4. And then here, we were about February, January, so maybe a month earlier. So yeah, Q1 would almost line up perfectly. That's crazy. That's wild. Okay, interesting. What about .com? Interesting. Yeah, it seems like before a recession, you get this longer trough in the savings rate. So let's write this down. I don't want to forget. I'm going to do this. Let's see. Let's put it. Let's write it down over here. Okay. So, and then I want to look at 2000. Personal savings rate fell, pretty clearly by like Jan of 05. Jan 2005. Personal savings rate anchors down to around 2.7. What are they yapping about? Hold on.
Headline July PCE, it's personal consumption expenditure.
Oh, they're just reiterating that. That's annoying. They put the whole breaking news banner up, and I see like the red banner. I'm like, what's the breaking news? And then we have December 2007, personal savings rate still anchored low, recession begins, and then the savings rate doesn't actually have its first big spike up until May of 08. May 2008, big spike. Okay, so that takes basically, how long is that? 2 years, 11-ish months to recession begin from anchoring low. And then you're really in it about another 6 months after that. So about 3 years and 5 months to from anchoring low to spiking. Okay. Now let's go here. That was 05. Let's look at .com. .com, we anchor low April 99. April 2000 or 1999, anchor low. Okay. And we hit recession March of '01. How interesting. So it also took about 2 years. That was 19 months. Just to confirm, the last one was a little bit longer. Jan '05 to about December of '07. Yeah, that was closer to 3 years. 2 to 3 years of anchored low personal savings to recession. Okay. And then those are our most recent times. 90s recession, I don't think anybody ever really refers to. Here you had an anchored low period. Oh, but this was between Paul Volcker. So you had your sort of double recession over here. That's a little bit more challenging. So we'll just compare the prior two recessions here. Oops. How did I do that? Oh, there we go. Mouse shortcuts. Okay. So, how low have we been anchored low now? Since about Jan of '02. That's when we really tanked down, which, oh, wait, make sure you can see that. Yeah, you can. Okay. Right there. Jan 22. So, Jan 22, personal savings rate anchors down to about 4.1. And it's now been, because now we're going to take even lower, because we have the August, or the July data, rather. So anyway, point is, we anchored low Jan. That's going to put us at 2 years and 7 months. That's crazy. That's wild. Somebody says, now pair that with the labor market. Well, what part of the labor market? Oh, Bullard's talking. Yeah, he's... Here we go.
I think it maybe was wise to be very careful and make sure that inflation was really coming down to the 2% target before they started an easing cycle. And so that all makes sense, I think.
Jim, I don't know if, did you hear it's Brian Sullivan, by the way. Did you hear the previous conversation?
Yes, I did.
Listen.
You want to talk boat prices?
Well, I would like to know what listen, you've always been a great guy and a straight shooter. And you can, and by the way, congrats, Purdue, great school, go Boilermakers. By the way, boilers are also up in price. I just wanted to point that out. But here's the thing. How much, we know we needed 2020 COVID disaster economy shutdown. How much do you think the 2021 COVID stimulus and the PPP COVID stimulus contributed, if at all, maybe zero, Jim, to inflation?
Now that I've been telling the story about the causes of the big inflation, and it's very, very much that the March-April 2020 response to the pandemic was big, and it was meant to be big, and I think it avoided a financial crisis. But then you got another package passed by Congress at the end of 2020 in December, bipartisan, very large. That was because of the Georgia election. And then again, when the Democrats came into power, as probably any party coming into power, they wanted to do something, so they passed another package. It's those two last packages that were overdone, and that's what led, right after that, we got a whole bunch of inflation, and we're still keeping the policy rate, very low in that environment. And then we had to scramble in 2022 in order to bring this under control. So I very much think that's what caused the inflation. And a lot of that spending was actually, basically going directly to people's bank accounts. That's about as close to printing money as you can get. And I think if a new Congress is coming up in the future should learn from this, that all you get is a bunch of inflation if you try to do stuff like that.
But if you look at the economic proposals of the two candidates running for president, you would say that there is a risk for that inflation to continue due to the impact on the deficits. Is mixed government kind of the only way to combat that if there's divided government in terms of party?
Yeah, I've been telling audiences that that's our best hope. That you get a split House, Senate, White House somehow between Republicans and Democrats, and that probably would keep the spending down. Even very narrow majorities are hard to work with. So, you probably wouldn't see a lot happen. But still, I'd like policy nationally to kind of return to
You're watching Squawk Box on
Oops.
CNBC.
What the heck?
Business. It's not a 9-to-5 proposition. It's all day and into the night. It's all the things that keep this world turning. It's the go-tos that keep us going. The places we cheer.
Okay. Why? There we go. Okay. Everybody can hear that now? Okay. Yeah, that was so weird. I was listening to Bullard, and all of a sudden I walked out of the room to go to the kitchen, and then all of a sudden it just bloom blooms, and then I come back over here, it's like, your browser has lost connection to your audio. I'm like, uh-oh, that's not good. Anyway, all right, problem solved. So I was looking at your comments while Bullard was speaking. I don't think we really got anything crazy insightful there. Remember, Bullard's not at the Fed anymore, so he could talk a little bit more freely, but I don't know how useful it is at the moment. But anyway, so this is that same chart, and all I did was throw the unemployment rate on it, and I have to say it's scary. Mostly because everybody's like, oh, I'm so worried about the jobs market and how it might indicate a recession. And every time people do that, I'm like, it doesn't indicate a recession. It's too late. It's the last thing that goes. And this reiterates it here. I mean, look, you during these low savings rate times, unemployment was very low. And it was just that those 2 years of low savings ended up with a recession. And towards the end of the recession is when you had the highest unemployment. I mean, you really didn't have noticeably higher employment or an increase of employment by 1% or unemployment by 1% until August of 01 in the dot-com bubble. And a 1% increase over here was probably faster. There, right there. It took until May of 05, kind of matched with the spike of the savings rate here. So, and then it just shoots up right after that. You end up shooting up at least another % or more. But the problem is that comes later in the cycle. So it's not great. Everybody's always like, oh, but your unemployment data will let us know if we're in a recession. No, it won't.
At Sandhill Global Advisors and a CNBC contributor. Brenda, good morning. It's great to have you here. In the last couple of days, we got, I guess, information that GDP, we entered the current quarter at like a 3% annualized pace of real GDP. You have inflation seemingly on target, 2.5% core PCE. It seems like things in the macro are okay, even if people are concerned about where it goes from here. How does that set up your market view at this point?
Well, I think, it's been a little bit of a choppy quarter. Certainly we started out in a choppy way, but as time has gone on, we've certainly learned, as you've just described, that I think this scenario for a soft landing is really starting to play out. So we're seeing it on the corporate side, where corporate earnings have largely been better than expected, appreciating at a double-digit pace. This week, normally a pretty quiet week at the end of August. That certainly isn't the case anymore, with the likes of NVIDIA and Salesforce reporting, as well as a lot of retailers, but still providing a great view into what's actually happening in corporate America. But I think the way we play this, I think certainly it makes sense to have some broad exposure to the equity market. I think that's one thing we've been very encouraged by this week, is that the Mag 7 and NVIDIA have not acted particularly well, yet the market has really held up. We've seen this continuation of a broadening trend where areas like small mid-cap equity have performed well. A lot of other sectors are really holding up. And so we think there is still opportunity in the equity market for sure.
Okay, whatever. So I'm curious about this. This is our current. Now keep in mind that, they just updated it. The personal savings rate down to 2.9. That's cool. It showed up over here. So it really shows you unemployment is now, rising above the personal savings rate. I wonder if that happened over here. Oh, that's interesting. Unemployment, personal savings rate higher, unemployment rate lower. You want that. You don't want it to be the other way around. You didn't actually have unemployment go above the personal savings rate here until like midway through the dot-com bubble. But over here in 2005, the unemployment rate was way above the personal savings rate for a while. That's interesting. So, I don't know. It's fascinating to me. All right. Anyway, okay. So let's see how L Market is reacting to this. Okay, so we've got TLT just up 4 basis points, pretty nominal. The Qs really didn't do anything. I mean, you had a little bit of a pop, and then you had a little bit of a drop. Okay, you've got, I think Tesla's up like 1.5%, 1.25%. Nvidia's up 88 bips. It's down 6% yesterday, though. I thought it. I didn't trade at all yesterday, actually, because I was traveling and a lot for House Hack, almost all day, and it was great and killing it. Hopefully, we put a little update video out too. But anyway, I saw. I would have guessed that Nvidia would have given us some more bullish signals of some kind of recovery yesterday, and it just didn't. So, like I said, I didn't trade it, but I thought it would have been a lot easier for it to hold on to the 123 line over here, and you could see it consolidate right on it, and it just tanked. Then you got rejected. I mean, it's like, look at that perfect rejection. And these lines have been here for a while, so it's not like I just drew them. So I saw this consolidation, then it gets rejected, and I mean, then it gets rejected, So that was pretty wild. Pretty wild. Okay. Let's see. Let's see. Okay. Let's see. Okay. There we go. Okie dokie. So let's see. That's this data piece. I wanna think about this a little bit more. This is really a phenomenon that we've seen of the prior 2 recessions, where the personal savings rate plummets for about 2 to 3 years before recession, and we're at the tail end of that now. We're at 2 years and 7 months. The prior was 2 years and 11 months. And the one before that was 19 months. So, fascinating. All right, let's give a listen here.
Much further action from here. Just mention a little bit as well on the inflation front in Eurozone. We got the numbers out of there this morning as well.
Yep.
Also in line with expectations, but a bigger delta on improvement there. So 2.2% coming in. That's down from 2.6%. It was in line with expectations, but it's a 3-year low now, the print that you're seeing Eurozone as a whole. And the stock 600 Europe hit a fresh intraday high during the session as well. So again, speaking to the picture there, Germany and Spain had bigger falls than expected. France had a tad hotter number than expected, but still at 2.2.
This is just nonsense regarding the volatility of some of the inflation numbers that you get in other countries. Hey, I'm going to run a really quick survey here, and this is it's just an idea, no guarantees of anything, but many of you already know we're a bunch of financial advisors, and one of the things that's pretty unique about what we do is we do a lot of real estate, which we find that a lot of financial advisors don't, mostly because, I hate to say it, but in financial advisory businesses, if you encourage somebody to buy real estate, they take assets away from you and put it into real estate, right? So you make a lower fee. And so I found it's really rare to have a financial advisor that does both real estate and stocks and finance and all that good stuff. And so what we were wondering is we just wanted to run a quick survey to see, would you ever be interested in actual wealth management? Like not only personalized financial advice that's licensed, but also wealth management. What we would do is we would custody basically your assets with JP Morgan, and then build sort of a wealth plan for you specifically. So I don't know if anybody's actually interested in that, but I thought it was fascinating because then it enables you to build a wealth plan and execute on it. You know, it's not like short-term trading or speculative stuff, like actually wealth building for, hopefully becoming a multimillionaire in real estate through a wealth management platform. And we thought that was a really unique thing because you just don't see that out there. Again, like you've got real estate agents, but they don't do finance. And then you've got financial advisors, but they don't do real estate. So they can't advise you on like, hey, is this actually a good deal in real estate? And how does it fit into my wealth portfolio, plan or whatever? So anyway, I thought that was interesting just because there are a lot of financial advisors. But we haven't seen a lot of people that do that. So I'll run that poll on the YouTube channel here. I just ran that, and I think as like the cost would just be in line with what you would see. So usually the way that works is like, it's some sort of if you have some form of minimum assets with the advisory business. It's, usually advisors, they'll charge, 1%, or they'll charge less if you have more, or they'll charge a little bit more if you have less, or they add on like an hourly fee or whatever. It's the problem with it is this time intensive, right? Because people are actually on the phone with you. And the way we'd probably do it is I wouldn't be on the phone with you, but it'd be my team. And then that way they can kind of go back and forth with me and brainstorm. So I think that's worth just sort of mentioning as well. That it's much more efficient that way, because if I'm on the phone, maybe I could have like 10 clients. If I can actually scale a business where, I train people, and then if they have questions about certain scenarios, they're like, hey, I want to run this deal by you or whatever, I'm there every day, and we can sort of collaborate on that. And so I think that's really interesting. But I don't know if that's of interest to people. Obviously we've got a lot of stuff going on, but we thought some people might be interested in that, but we don't know. So we thought we'd run a survey or whatever, see what some of your comments are. Okay, so with that, I want to see what some of the suits are saying, and I want to see if Nick T said anything about PCE. Somebody here says, I have a company, but many lack proper balance between stocks and real estate. Yeah, I agree with that. Yeah, I totally agree with that. There's sort of a balance between, hey, how do I, should I get a bigger house? Should I start with a rental property? Blah, 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 blah. Somebody says, already have licensed wealth management. Yeah, that's great. I don't think you should do something. You should replace your wealth manager unless you're unhappy. We're not trying to steal people from anyone. So we just thought it was interesting, the real estate balance then. I don't think you would think of it as like like everyone's it's not like, oh, here's one product for everyone, right? So Caro's like, hey, what's the expected performance versus other wealth managers? I mean, that depends on what everybody's goals are, right? You know, somebody who's like 80 years old that, you know, is like, hey, I just want steady cash flow. They could be all in on treasuries. You know, they're not going to be in an Apple stock or whatever, right? You know, somebody who's getting started might be like, look, I got, you know, 50 G's. Should I go buy real estate or should I go, you know, buy NVIDIA stock? You know, those are going to be very, very different portfolios. So it's all, that's the whole point about personalized advice, is trying to figure out like what exactly is somebody looking for themselves, and, you know, how can they reach their goals? So anyway, I think that's very interesting. Someone here says, my problem is $60K a year doesn't warrant a financial advisor. You know, I actually think that's a very good point. You know, there are a lot of, and unfortunately, that's probably where people need the most help, is, you know, in that, like, the salary range of like 60 to like 120K. Like, how do you get to that next level? How are you actually going to be able to afford real estate, like, ever, right? And so I think that's where some of the biggest needs are. So I thought that was interesting. That's a good comment. So anyway, somebody here says, interesting grift. You know, I think that's interesting to think that professional wealth management, it would be considered a grift. But I think that's just like internet culture. It's like, oh, anything anybody does on the internet's a scam. Okay. Yes, it's on the internet, so it's a scam. I remember back in, like, you know, the AOL days. Oh, that's like, why would you buy an airline ticket online? That's a scam. And instead, it's like, I'm gonna call the airline and I'm gonna let them mail the ticket to me because that's a scam. I think that's kind of funny. And I remember that. My parents used to do that. They would order, like, you could buy the tickets online, but they would always order them for like the, you know, first few years it was available. They would just order online. And I'm like, what are you doing? Why would you do this? And they're just like, yeah, well, you know, we don't trust the internet. Like, okay, everything's a scam. At this point, I've kind of just gotten to laughing about it because I think, you know, I think people know you can be multifaceted. Like, there's yes, you could be a YouTuber, but wow, you could also be really good at real estate or really good at building long-term wealth plans, right? And that's not to say that, like, you know, I actually think one of the cool things about wealth management is you can help people look and say, okay, like, what portion of your portfolio should you be even thinking about trading, right? Like, is trading even good for you, right? So, like, what's your personality? What's, like, you know, are you a fit for that? And then I think you could actually look at people and say, like, hey, like, you know, for your situation, let's focus on getting a house first and not focus on day trading, right? Or somebody with a larger portfolio might be like, all right, let's maybe, if you want entertainment, let's put aside, you know, 1/10 of 1% of your portfolio for trading, and let's focus on the rest on, you know, maybe do we get into multifamily? Do we get into commercial? Whatever, right? And so I think there are some really cool things about what we can do. But again, because of that balance between real estate and finance. Okay, anyway, so I was just more curious about that. I don't want to waste. Steve says 100% of your portfolio is for trading. That's funny. So obviously a joke. So you know, J-Bone's talking about Elon sleeping on the floor. You know, a lot of people have come out after that and suggested that Elon, like, slept on the floor, like, 1 or 2 days, and that he was, like, rarely around the factory in those days. And it's really interesting when you look at some of, like, the commentary of ex-employees. You don't know if they're just, like, bitter and hating on Elon or what, but there is this counterbalance narrative that's sort of come out, this idea of, like, oh yeah, no, he wasn't actually there that much. All right, let's listen here.
Didn't call it because the unemployment rate didn't go up. But now we have that unemployment rate. I'm not calling a recession. I'm just saying the Fed, if it goes down too slow, is taking a risk that I don't think it has to take.
Professor Siegel, thanks so much for joining us. Great to see you.
Yeah, I actually love that we just ended on that. Hold on, let's go. Let's go to this one. Yeah, I'm gonna pull up. Let's see. I'm gonna see what we've got in terms of bear bull pieces here. That's a good point. Thank you for bringing that up in the chat there. Sometimes I get distracted. So what was I just talking about? I don't know what the hell I was just talking about. But anyway, all right, let's go get some bear bull pieces. Oh, yeah. What the guy on TV said. Yeah, basically, I agree with him. Like, the Fed does not have to risk a recession here. The problem is they're still so lingeringly worried about inflation, and frankly, I think we're heading towards straight up deflation. And it's sad because, you know, you're creating an unnecessary recession. So I don't love it. I don't love it at all. All right, let's see what we got here. So, okay, global forecast. What's our global forecast here? What is this? Chief Investment Officer, global forecast. Oh, this looks interesting. All right, let's take a peeky-deek. Let's see what we got. Okay, so all right, CIO forecast tables reflect UBS's CIO views on growth, inflation, interest rates, currencies. Okay, so I think they're going to say, I don't know, I haven't read this yet, growth flat, inflation trend down, interest rates down, and then flat. All right, let's see. Okay, are these just gonna be charts? Oh, that's really boring. I was really hoping for like a narrative here. Oh, this is extremely boring. Oh, you gotta be kidding me. It's just a stupid... That's lame. Target rate, so it just gives you a little breakdown of what people think in terms of rates. Yeah, this is really where people think it'll terminal out at about 3.5 right now. All right, I thought we were gonna get commentary on that. That was stupid. Come on, UBS. Like, at least add, like, a paragraph. Oh, well. Can you believe it's almost... August is almost over? Jack's birthday is tomorrow. Oh, which reminds me, it's the Labor Day sale. I forgot. I have not pitched that at all, really. There. Labor Day sales coupon. Who donated $20? Is talking... Ish? I don't know what ish is. Wipe from AI tier. Oh, so yeah, that's actually an interesting question. Somebody's like, hey, is there a risk of like, financial advisors getting hit by AI? Probably, but what we found is that the last sector to really get hit by AI, in our opinion, is real estate. It's very hard because, what you want to think about when it comes to that is everybody should be thinking about this personally, is you should be thinking about, what's the appropriate budget for renovating my house? What's the appropriate, house I should be buying? Is this a good deal? Like, it's almost like, think about it almost like advice from a licensed real estate broker and financial advisor, that balance, right? And that's what we think is so interesting because AI has a really hard time with real estate. The only way we found AI is great with real estate is identifying things that look like wedge deals. And we've had that AI since before AI was AI. You already know that. We've had our wedge finder AI since 2018 ish, and it's amazing. So I think that's really interesting. But yeah, I mean, like generic stuff, like, generic questions or whatever. I think it's wonderful because people can actually come a lot more prepared into an advisory sort of consultation, or because maybe they've already run their situation through sort of basic level AI. But then how do you try to get GPT to actually help you with real estate? It's a lot harder. And so I think that, again, that's why I say that there's such a differentiation. But yeah, I think that human human touch still matters a lot. They had a study. They're like, what did, for people treated, what was it? People in nursing homes, taken care of with AI. And it's like, oh yeah, they're able to have better analytics on their data or their charts or this, that, or whatever. But the biggest thing that was a factor in somebody's personal health outcomes was the human touch of a nurse. I honestly kind of got a little sad about that. I'm like, man, that's sad. That it's kind of like you're trying to like replace away the humanity, and then especially in when people need it most. But anyway, all right. So what do we have here? We present at trade shows because customers want you using AI. Can't figure out how to make money with AI yet. Zeitgeist. We present at trade shows because customers want to see you using artificial intelligence. Can't figure out how to make money with it yet, though. Okay, got it. The price is right. 60K Bitcoin, reversal higher in bond yields, likely on positioning thanks to UST inflow week. Okay. This is issuance, basically. So what else do we have here? Protectionism, biggest picture, policy put, BOJ capitulation, blah, blah, blah. Okay, let's get some more details here. Okay. BofA bull bear indicator rises to 6.2. Oh, they have a bull bear indicator too. I'm like 3, I think is what I had yesterday. And I'm sticking with it. First weekly rise of the BofA bull bear indicator in the past month on big inflows in stocks and bonds. Okay. Additional hedges against a lower S&P 500, stronger Japanese yen. Hedge funds continue to add to bullish view on Japanese yen, which just exacerbates the carry trade. 11 minutes to bell. Okay. BofA private clients selling stock into strength. Outflows in the last 3 weeks. Continue to trim T-bills. T-bills are your short-term notes in favor of T-notes, so a little bit longer duration. Bills, notes, bonds. So what else here? ETF private clients, buying REITs, financials, healthcares. New entry point for longer bonds, seasonality. Let's see, geopolitics, lifting energy prices, positioning. Moved from oversold in Q1 on the 30-year treasury from oversold. Oh, now overbought. Oh, great. First time that investors turned to overweight bonds for the first time since March of 24. Well, that's not that long ago. Extreme Fed front running. Market pricing in 200 basis points of cuts in the next 12 months. Fed hopes as bullish as it gets despite V-shaped recovery in risk assets. Yeah, that's actually been somewhat of my concern, is that Kevin's been, one of the reasons Kevin's bear, I call it the bear bull, scale is at just 3.3, is that markets may have front run the entire rate cut cycle, which unfortunately, down to, I'll say down to 3.5%, which unfortunately, as earnings flatten out, suggests we may be topped out on equities and may lead to layoffs, the layoff cycle as companies try to spur their stocks, right? That's been somewhat of my thesis. Had your bear bull scale to the screen every day. That's not a bad idea. Actually, that'd be kind of cool. What I should do is do like how do I do this? I think I can. If I had like one of these, right up, and then I just plopped myself into the corner, and then we threw Weeble in the middle, and then it had like the bear bull scale on it. That'd be kind of cool. Take a little bit of effort just updating it all the time, but I find it interesting. Okay. Keep going here. Exporting deflation. Anyway, thank you so much for voting in that poll on if you'd be interested in actual, wealth management. And we plan to custody with JP Morgan, just so you know. So it's not like we're holding your money in your stocks. You know, we just help you manage it. But you basically open an account with JP Morgan, which is kind of cool. So we're really grateful for our relationship with Chase/JP Morgan. They're really good to us. All right, China GDP 5%, but domestic growth slows. Consumer confidence this is China. Consumer confidence near all-time low. But I did just hear Alibaba pop, didn't it? Pretty sure Baba completed, but that may have been on some regulatory changes. Yeah, it's up like 4%. All right. Government dominance and payroll growth is not bullish productivity. What? Government and private education and healthcare growth sectors. Oh, interesting. Oh, I get it. So basically what they're saying here is like, you know, when most of your gains, when gains are concentrated in government, health, and edu, you're basically in, don't expect higher productivity / EPS probably from companies, right? Now, how has that fared in prior recessions? Oh, wow. Yeah, look at that. Oh, that's freaky. It always peaks. Hold on. Payrolls? Whoa. It always peaks in the recession. With the exception of 82, but that was your double dip Paul Volcker recession. It did the first cycle. Look at that. So the light blue line is the peak before the recession, and that's private payrolls. And private payrolls always peak before the recession, and then they plummet. Wow, look at that. That's really interesting. Oh, that's bearish, right? And then look at I'll do a green one here, and the peak in government comes like, you know, a double peak here, but really, really close to before the recession. Oh, look at that. Oh, no. Oh, no. Wow, that's a great chart. That's also scary. Okay. That's wild. Circular bull market and commodities just getting started. Maybe. I don't know. We'll see about that. Market hopes for Fed cuts as bullish as it gets. Telecom healthcare at 44%. Okay. Oh, no way, dude. Holy crap. Look at the .com peak. No. Holy crap. The .com peak was 44% of global equities, tech, telecom, and healthcare. And in the 2008 crisis, it was financials, you know, like real estate and banks or whatever. They peaked at 44%. We're at 44%. No. This is a bearish piece. No. And I'm just reading charts that are actually kind of being presented in a neutral manner, I feel like. No. Wow. That's crazy. Largest inflows into treasuries since October 23. 4 minutes to the bell here. Largest inflows into REITs. Good old real estate. Oh, yeah, look at that. There's their bear bull indicator. Wow. Extreme bearishness. Extreme bullishness. Nice. Knocking on that door of the sell over there. Okay, all right. That's interesting. All right, I'm going to end this poll. Oops. If anybody else wants to leave a poll vote there on YouTube, we just ran a quick poll if you'd ever be interested in wealth management. And the reason we ran that poll is because we think we have a unique offer and that we would also have, I mean, the foundation of it would be real estate, which is ironic because most wealth advisors don't want you to buy real estate because now you're taking assets away and the fees then go down, right? But we actually think that real estate is where people need the most help, but it should be with a balanced outlook and portfolio, right? So anyway, I think that's very interesting. All right. So what else? All right, let's end the poll here. And what else? Will it be available for Canadians? Oh, that's a really good question. I mean, Investment Advisors Act, why couldn't I? I mean, I'm not... Does it regulate where the financial advice is coming from or where it's going? That's a really good question. Honestly, let's just ask GPT really quick. Can a licensed financial advisor in the United States charge to provide financial advice to a Canadian? I don't know the answer to that. I mean, I'd want to verify it. It says yes. But there are several regulatory and legal considerations to keep in mind. The advisor must be aware of complying with both U.S. and Canadian regulations. So you need to adhere to the Canadian Securities Administration. Oh, yeah, that'd be tough. The U.S. advisor might need to register or be exempt from registration in Canada. Ah, interesting. Okay, so I'll have to look into that. Canadian Securities. I'll look into that. Thank you for that. Great question. Anyway, all right, we're about to hit market open. Good luck, everybody. Keep in mind we got the Labor Day sale going on for the courses on building your wealth. Thank you so much. Wow, actually a lot of you, like almost 1,000 of you said you'd be interested in wealth advice. That's crazy. Oh, wow. Okay. All right. Jeez. Wow. Thank you.
See what has led to the bounce back. Clearly, the likes of Nvidia bounce back very, very strongly, but are still below their lows, where it's other sectors that have come back to all-time highs. So there's been that breadth in the bounce back, albeit everything has benefited for sure in the latter weeks of the month.
Yeah, there was the opening bell, of course. You can take a look at the real-time exchange back at our headquarters here at the big board. And Juliet celebrating 750 performances on Broadway. Over at the NASDAQ, Entrepreneur Shares, that's the first ETF investing in private equity.
All right.
Kind of interesting. All right. Not sure where we want to start this morning, but we got any number of earnings movers, both up and down, whether it's Lulu up, Ulta down, Mongo.
Let's take a look at this. We got the Qs rising. So let's look at trading stuff. Qs. This. I just want you to pay attention. If you're trading today, really watch that 476 line, please. It's not personalized advice, you know that, but 476.26 honestly is frequently problematic for the Qs here. I'm actually surprised. Yeah, I didn't mean to hit that. I have my soundboard kind of like right where my fingers go when I'm using this. Just kind of funny. But anyway, this is really interesting. This 476 line, and I think it will be the rest of the day. Let's put some other tickers up here on the left. Let's go with Tesla. Oh, look at that. Tesla's got a nice little run. We saw this yesterday, though. Watch the pattern yesterday. So, you know, look at that. Look at this. You skyrocketed yesterday all the way up to about 215, and then you just tanked the rest of the day. So not saying you can't trade it up, but just you know, maybe don't hold on to it too long. Okay, let's try Nvidia. Oh, wow. Why? Oh, my lordy. I mean, this was only up about 88 basis points, and then it started, you know, it did actually run into the open. So, you know, maybe that's reasonable. Okay, interesting. So, then... Let's see. TLT is only up 10. That's kind of crazy, too. What's another one? Let's look at IWM. So IWM's up 40 basis points. So the Qs are up twice this. And then we've got... Oh boy. QZD IWM's now rising. That's a nice jump there on IWM. We just went, oh wow, look at that. Went up like 15 basis points just as we're watching it. It's like as soon as I start looking, it starts going up. So somebody says, doesn't believe in AI, then uses AI for board questions. You think I would just start with that? Come on, don't be silly. I think it's actually totally, and in fact, that's exactly what I said. I think you should start with AI, but then verify, right? So then, like, I have it up on screen right here. I clicked over to the Canadian securities admin, and I want to find, you know, where the info is on it and where I could find it. So, but I like actually reading the black and white rules. I think but that's how everybody should think. It's like, what's your initial suspicion? Get an idea and then go verify. You know, I think that's totally reasonable. And I think to suggest that that's somehow bad is delusional. But whatever. I mean, you might just be leaving a hate comment. Anyway, so yeah, see, look at that. This is what I was saying with Tesla already getting a little bit of that that drag here. TLT spiking a little bit. Okay. Well, probably because stocks are, I don't know what's going on here. IWM popped up quite a bit. I mean, IWM is about to gain over the Qs. And I think NVIDIA is just acting like an anchor right now. And Tesla's trying to help this sucker stay up. But boy, it's getting a little challenged here. Nice green candle now on Tesla. Okay. Affirm, not really going anywhere. CrowdStrike. Wow, okay. Okay, above the 281 line on CrowdStrike. What else here? Rocket Mortgage, LDI, Loan Depot. Some of the mortgage companies are up a little bit. But they were down yesterday. It's up and down daily, it feels like. Almost at 200 on Ubiquity. That's cool. Dell after earnings is only up 2%. That's kind of lame. And Palantir didn't look like it was really moving a lot at all. Palantir. No, Palantir's flat. And then if I go Intel, wow, Intel up 5%. Hey, got some call options on Intel. Those will do well. We talked about that in the courses. But, okay, what do we have over here? Ulta, down 5% after, what's his name? Warren of the Bee. Although it ran up, obviously, after he invested and people heard about it. And here you go, struggling really with the Qs. I mean, it's a little fanatic here. I'm trying to find a trend on NVIDIA. Let's listen in here for a moment.
Had been, of course, for a long period of time, a high flyer, benefiting enormously from the fashion trends that it introduced.
Yeah, I think if we can get the intraday, by the way, it did start higher.
It did. It was higher this morning.
So it's turned all, not just in the pre-market, at the open itself. So we've seen quite an interesting turnaround in the last couple of moments there. It was a couple of percent higher at the open and now a little bit lower. And as we mentioned as well, Nike's one of the few Dow constituent decliners as well. Maybe that's slightly in sympathy. Nike's down 0.4%. Only 3 of 30 stocks on the Dow lower. And again, coming back to that point that for the week and for the month as a whole, the Dow has been doing pretty well over the course of the month.
I wanted to come to MongoDB. We saw those shares leading in part the NASDAQ. Total revenue, $478 million for the second quarter. That was up 13% year over year. Subscription revenue as well, a 13% increase, and clearly being responded to positively in the marketplace by investors. I do, oftentimes now look sort of at the difference between GAAP and non-GAAP wealth, because in some companies it's very small and others it is quite large. And here it is certainly notable. Will it matter at any point? That remains very much unclear. These companies are based on their adjusted numbers, on free cash flow to a large extent, but stock-based compensation is often the biggest key in terms of the size of the variance between GAAP and non-GAAP. And here you're talking about a company that would have lost 74 cents a share in terms of GAAP, but obviously made 50 over. Let's see. What? I'm sorry. I'm just making sure I have the numbers here.
Mongo.
70 cents a share. Excuse me. On non-GAAP, and that's always interesting. Both of these gentlemen are going to be guests on Money Movers, so certainly can ask about that. But, does stock-based comp ever become an issue for companies is a question that any number of investors have had over time. If you go through a very difficult period in which you can no longer be paying in
someone here in the chat says a firm is shooting up. Let's take
straight down or for any number of other reasons, and you actually have to replace it with cash, that obviously would impact profitability in a significant.
You're right. A firm also has a line that it's approaching. Look at this. A firm's right there at the 43, what is this? 43.11 line. And then you've got Tesla struggling a little bit. Oh, Nvidia just had a nice peak or spike there. 119. Q's had a nice peak there with Nvidia. Nvidia is now starting to trend up. That's going to pull the Qs with it. Just in the last 2 minutes here, that's a pretty big uptrend there on Nvidia. I don't think there was any news on Nvidia. I'll check really quickly, but that's wild. That just came out of nowhere, especially since we were kind of dragging down there for a moment. So, no, nothing on Nvidia. And then Tesla just popped up a bit as well. Although it's having a little bit of a hard time. Q still barcoding a bit. It seems like the market wants to be bullish today, but IWM now peaking out. So I'm wondering if you're going to do you get a downtrend from here? See, Tesla just can't keep it up. And I think Nvidia drives the day today. That's going to be what I'm watching. Let's go back to, actually, let me listen to Doomberg for a moment. Can we look at Ulta and Lulu? Yeah, we'll do that in the course member live. We'll go do a fundamental analysis of those. I think that's a great idea. I think I had another one I wrote down over there, but we could do those. Oh, okay, let's see here. Let's listen in to this. Oops. There we go.
Technology. And so we like that broadening trade. That's very satisfying as a portfolio manager as far as the impacts that has on a well-diversified portfolio and long overdue. You talk about energy, you talk about discretionary. That's another good reminder that we are in this late cycle environment. Late cycle can go on for a long time, and that's the base case again. But you're also seeing these pockets of weakness in some places. I wouldn't extrapolate that too far. When we're looking at this broadening trade, GDP, earnings, the broader sentiment, optimism on rate cuts. What we're seeing here is Russell 2000's beat the S&P over the last 3 months. That's phenomenal. And even over the last month, you've even had international developed, the MSCI EFA index, beating the S&P over the trailing month. So that's wonderful to see in portfolios that sort of baton is being passed from the AI trade and tech trade into the rest of the broader market, not just US, but internationally as well.
Adam, we thank you so much for your time. That is Janice Henderson, Global Head of Multi-Asset. Adam Hetz, have a great weekend to you. We're going to take a look at some movers this morning because, yes, we are up on the S&P 500, but certain stocks are certainly down on the day. Lululemon in particular, we were talking about it. People had thought here that the cuts were really priced in, but now we're seeing the stock lower by 1.7%. MongoDB just on a tear, Katie, up more than 17% today after promising earnings results here. You are seeing very interesting movement in the tech sector. I would also note, not on this board, Dell as well, flying higher. Ulta Beauty now down 4.4%. I know you were watching that. We both love to buy makeup. And so obviously Berkshire Hathaway has loved to buy Ulta as well, but not feeling the love from that stock today.
Definitely a summer Friday with Sonali and I just...
Yeah, Lulu's down about 2.3, Ulta down 4 now. A firm just got rejected at that line, by the way. It's actually dropping roughly at that line, which is kind of crazy. Nvidia keeps legging up, by the way. Wow. Okay. But yeah, you definitely got that drop there on what's it called? On a firm. So I'm going to be watching this. And let's see here. Okay. And I thought was very interesting. this move on Nvidia. This is now, we've seen this now multiple times, and I'm kind of watching sort of what the market's doing as well with options pricing. This let's see here. 120. Next stop, honestly, for Nvidia here is like 123. And it seems like it wants to try to go in that direction, and that's probably gonna take the Qs with it, would be my guess. Let's see here. So you've got Tesla still bobbing around 1%, which is fine. Affirm did not like that line. Okay, write that down for Affirm. I'm gonna write this down. So I'm gonna write down QQQ 47623. Affirm, I'm gonna write down 4309. And I'm going to put a down arrow there. I'll put a down arrow on the Qs at 476 since I think that's going to be a reject point. But I will say, Nvidia keeps wanting to go. I wouldn't be surprised if it's trying to get to 125, but let's see if it can. Tesla's now moving up nicely. And I think, what else do we have? This is, yeah, I want to watch Affirm. Yeah, it keeps getting, gosh, it's getting smashed. And that line's been there for a very, very long period of time. Potentially years, honestly. So I think it's very interesting. So we'll see what happens here. But anyway, okay. So what else have we? Next thing is, let's see here. Qs. Yeah, Qs are moving up with Nvidia. Okay, let's go. Affirm closed the daily gap from February 12th. Might be a brief ceiling for a retrace trade. Yeah, maybe. Maybe, baby. All right, let's go in over here for a moment.
Staples and real estate and healthcare and utilities all significantly outperforming. These are just different ways to slice and dice the broadening out of the market story. If you look at mega cap tech, just call it a lackluster August. It's not a bad August. It's just a lackluster August. Look at the movement here. So here's your major indices with the equate, the S&P, and the Russell 2000. But look at mega cap tech here with Apple's just up and most everything else in the mega cap tech area like Microsoft, Nvidia, Alphabet, and Meta all not doing much at all. By the way, on the earnings front, Nvidia has put the S&P 500 earnings over the top here. We've had a terrific second quarter. Look at this, up 13%. We started the second quarter 9 or 10% expectations, now 13. Nvidia helped that when it finally got over. We're basically done with the second quarter, but look at the rest of the year. Q3 and Q4 strong. We're going to do 10% earnings growth this year. The estimates are 15%. This is why the stock market keeps holding up overall. You see generally good earnings numbers and decent economic numbers. So people ask me whether we're too bullish right now. I'd say sentiment is on the bullish side, but not wildly so. If you look at the AAII weekly numbers here, the important thing is we're seeing here some bullishness, Wilfred, but not, I'd say, overly enthusiastic or not overly effusive here. Bottom line here, we've got a weak September and October, but the numbers are on the side of the bulls. Back to you.
Well, Pisani, as always, thank you so much. We've got some data crossing, Chicago PMI. Let's get to Rick Santelli.
Thanks, Wilf. Yes, Chicago PMI for the month of August, expected to be a bit under 45, comes in much better than expected. 46.1. It's not only sequentially higher than
it's still contractionary.
Mirror. It's the best level since June, and it's the second best level of the year. We all know that the last batch of numbers was mostly as expected on the inflationary front. Solid income and spending. We see that yields are down on the week by 1 basis point on a 2-year as we sit at 391. If you look at 386 and a 10, now 387, that's actually up 7 basis points on the week. The curves had some movement. Last week, of course, we were hovering around minus 10, minus 11. We've shaved that basically in half. Squawk on the Street will return after a very short break.
All right. Okay. 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 Let me get that little edit in there. All right. So, let's understand what's going on here. Okay. For what do we got? It's 47. Okay. All right. Very well. So now, what I'd like to do is, oh, that's not good on Tesla. I don't understand why Tesla's acting like this. It's having such a hard time keeping it up. It really is, and it's kind of annoying, because I keep looking at Tesla, wanting to trade it, and 2 days ago was great. I was killing it with Tesla trades. I did 3 Tesla trades, and each of them were positive. One of them was like 66%, which is great. Today, I have not been confident on Tesla on anything. I mean, look at this. How could you be on that chart? So then you've got the Qs that have an uptrend slowly. It's not like euphoric, but I think 476 is where you go. You're not that far away from that. I mean, you're, $1.25 away from that. So it seems within the realm of reasonableness. Let me see here. 476.26 divided by where we sit now would be an additional 22 basis points. Like, big deal. And I think the way you get there is NVIDIA rallies. Because remember, yesterday it was up. It was down like 6.5%. And so what I'm watching is, I just want you to see them. I'm watching these lines right here. I think we almost certainly get to, and obviously it could be totally wrong, so it's not, personalized advice, obviously. But I think there's a good chance of getting to this 122 to 123 range. When it gets to here, I'm really looking for a breakout to the 125.59 line. That's I think one to watch. I don't know how much will go beyond that. Anything that it goes beyond this is just sort of like more like euphoria for today at least. And that's okay. That might happen. Sometimes you get it to run up to like 127 or whatever. But who knows? That's just an idea. Tesla's trying to come back again. Qs are almost up 1%. TLT up 7 bips, 6 bips here. Palantir's starting to try to come up. Look at IWM though. A little bearish here. Not great. Why? This is sort of feeling a little bit like yesterday on IWM there, where all of a sudden you get a bunch of red candlesticks. Little weird, will say. Was not expecting to have a little IWM poo. So weird. I wonder why. We do have U of Mish data coming out in a moment. And let's see here. We have Chicago PMI. I mean, it's still contractionary, so I don't think that's a big deal at 46.1. I know Rick was excited about that coming in more. But what's going on? Somebody now saying SPY. Yeah, IWM's dumping for some reason. Yeah, SPY just dumped a little bit as well. Not so bullish for trying to see some of these extensions. You really want to see Tesla get out of no man's land over here. 221, I feel like, is where we should be heading next, but it could very well also be 200. You did have Ulta recover, Lululemon starting to recover. Affirm got rejected, but it's starting to recover. Now you've got SPY kind of recovering here. This is why I always say, like, if you set limits, you have to be careful setting limits too tightly, because then you get shaken out, whatever, by some of those more nominal movements. It makes it a little bit more challenging, obviously. But wow, look at that. This is on SPY, by the way. Look at that SPY move. Holy crap. Holy crap. Somebody says, what kind of shit is it? I know, right, dude? I'm telling you, man. Sometimes it's just freaking comedy, dude. It's just comedy. All right, what's BT Sizz doing? BT Sizzle. BT Sizzle took a poops. A poopy doopy. BTC has just not been a good tool as a leading indicator anymore. It used to be so good, man. It was so good. But, That's what happens, is you find something good that makes you money, and then everybody knows about it, and then it stops being good, and you got to find the next thing. Well, that's called trading. The inverted yield curve right now is about -5 basis points. So still got a little bit of work to do. I do want to say, I think this is kind of crazy here. I just wanted to really thank y'all for this. When I ran the poll, would you be interested in wealth management and financial advice from Kevin, where we custody your assets with JP Morgan? I thought maybe like 10% of people who voted would say yes, just because, you know, it's like, it's a product, you know, it's like most people are like, nah, you know, I'm good. But 882, just over 882, probably because I'm rounding down a little bit on that, it's probably closer to about 900. About 900 of you said you would be interested in that. I'm kind of surprised by that. I did not think that. Thank you. Like, I'm not trying to like pat myself on the back, but I obviously if like 100% of you said no, I'd feel a little sad. So this is the opposite of that. This is fantastic. So, but anyway, I sincerely just wanted to say thank you, and let me see what I can do with that knowledge now, that information. So, all right. Okay, so, all right. Okay. Nvidia's up 3%. Okay. All right. Okay. I don't know with certainty if it's gonna happen, but it's on the 15-minute uptrend now. And the lines are here. You're going to get volatility. You're going to get the ups and downs on the minutes. That's normal. Okay. All right. So NVIDIA's trying. It's really got to stay above 3%. And quite frankly, once it breaks 122 and it holds above that, a little bit more than 122, the 122 line, I think you get to 125. No guarantees, but watch that line right there. Write it down. 122.59. That's what you're trying to break. So we'll see. Okay, BTC coming back a bit on that red candle. Wow, Ulta and Lulu, we're going to do a fundamental analysis on these, but wow, not bad right here. Both of them recovering. Ulta Beauty has a line at 368, and I know a lot of people like this one because of Buffett, obviously, more recently here. And it used to be a very, very high flyer. It was a great play. Up about 10 bips on TLT, which is basically nothing. Oh, look at that. Within 10 cents of my line on QQQ. Wow. Wow. That's crazy. Okay. Hold on one sec. Okay, so somebody's asking about what I said about Tesla. So what I said about Tesla, just to clarify it, is on a technical basis, 221 or 200 is the trajectory in the near term. On a fundamentals basis, unfortunately, I think Tesla is a little overvalued right now. Unfortunately, you know, that as we get back to growth, that will become less pressing, I suspect. Anyway, okay, here comes University of Michigan's coming out in 4 minutes. All right. So that's going to be a little bit probably of, I don't know why the market moves on stuff like that, but it does. All right, let's go take a peek here. Let's see here. How do you deal with the psychology of selling a stock? Somebody's asking, and then it runs up. I mean, the way you have to look at this, and it's very hard, but the way you have to look at it is you basically, unfortunately, you paid a price for preventing the loss of more money, right? So, like, hey, you know, you have a fundamental thesis as to why a certain stock might perform poorly over the next XYZ, you know, you're thinking about your personal investment portfolio or whatever, so you sell it, and then it runs. You know, the way you have to look at that, sadly, is you zoom out into the long-term picture and say, would you buy it again now, or would you have sold it now? And A, that helps. And then B, you look at it and you go, there's a price to pay for protection, right? So I like to think of an analogy like, let's say you're retired and you have $2 million to live off, and you're 70, and it's like, all right, you got to live tight just to survive off that and not have to work again. What if all 2 million were in a certain stock, and if that stock went down half, you'd have to go back to work. And if the stock went and if the stock stayed where it is, or you sold it now, you didn't have to go back to work. And if it doubled, you also didn't have to go to work. You just had a little bit more spending money. You have to sort of evaluate, well, how much am I willing to have paid, right, for avoiding that downside risk? And that's unfortunately the downside of stocks in the short term. That's why usually the best build out for people is something that's at least 20 stocks diversified. Is generally what I say. Or like 20 securities, right? That could be a balance of treasuries, it could be different securities or whatever, but think about like Warren Buffett's 20 punch card. That way you don't have to so much worry about one stock and that one stock performance, because I know that drives people psychologically crazy. And then you're never going to win, because then it's like, like for example, I put like 5% in Ubiquity, right? And I did that at like 140, right? And I was talking to course members about that at the shelf. I'm like, hey guys, like I think this is going up. Here's my fundamental thesis as to why. Here's the analysis on it. Here's the balance sheet analysis on it. Obviously, I could be wrong here, but here's what I think about Ubiquity. And now, I look at it, I go, well, if only 2 months ago I just put everything into it as opposed to 5%, right? Like, you can never win, because then you could have put everything into it and it could have gone down to $107, the line below it, and then you'd be pissed. So anyway, Chicago comes out in a moment, but yeah, psych is probably the hardest part of life, honestly, the psychology. And I think that's where somebody says I'm employed by Ubiquity. Bro, where's my sponsorship? Dude, we just did our entire office with Ubiquity cameras and door access keys and cards and fobs and the little things that greet you. Hello, Kevin, when you walk in. It's so cool. University of Michigan sentiment comes in lower than expected. 68.1 was the expectation. 67.9 was the result. Inflation expectations come in a little lower than expected, which is good. 2.8 versus 2.9, and then on the 1 year, and then 3.0 on the 5 to 10. Yeah. But anyway, yeah. Come on, Jeremy. Where's my Ubiquity sponsorship? Man, I'll break out the knee pads. No, I'm just kidding. I honestly, I love you guys' products. So, but anyway, yeah. I think that's why having like an advisor, I've found myself, I'm just like, having somebody else to talk to about this stuff is so useful. Anyway, sorry, I don't mean to like belabor that. But anyway, on this latest Mish report here, we are getting a pop in Nvidia. Let's frickin' go. All right, let's listen in over here.
Market value. We're going to speak with the CEO of a company with a similar business model, Compass Diversified.
They're going on commercial. When they play the music, it just means they're going. I think y'all already know that by now. Here we go. Oh, let's get the anger.
Reads get tossed in a new read. Well, 67.9 replaces 67.8, and that remains the best level since June of this year. If we look at current conditions, 61.3 usurps 60.9, a nice little bump there, and that remains, both those numbers remain the best since Dece of 22, those are the best since July. If we look at 72.1, that's expectations, that equals exactly what the mid-month read was, and that does remain the best since April of this year.
Okay, big deal. On this latest news, QQQ is testing 476.26. You don't want to break under this again. You want to hold this puppy. I think what's driving this is Nvidia. Nvidia needs to get to 122-ish, 122.50-ish, and then I think it's a clear road to 125.58. Let's see if it can hold it. Honestly, just the past minutes that I've been yapping, it went down when I first started talking about it. Usually I feel like when I talk about something, it goes down right afterwards. If I say, this might trend up, it goes down right afterwards. That's just, I feel like, my luck. But like I've kind of like sort of built that into my trading psyche. I'm like already aware of that, and so I try to just zoom out a little bit. But anyway, these lines are critical here, and these lines will push up, in my opinion, Tesla and the Qs. Right? I mean, and you're seeing that right now. The Qs are supporting the 476.26 line. Really important. Not only are the Qs supporting this line, but Tesla's at 210. Again, it's in no man's land, so it's not perfect, but you know, we'll see. I don't like no man's land, but we'll see. Okay, all right, good. So now let's see if if the Doomers are going back to that interview they were thinking about doing, or whatever the hell it was they were trying to do. Let's listen over here.
Jobs report, because it's telling you the hiring rate. That is what gives you a really good feel for what's going on in the labor market. And hiring rate is down 43% for the first 7 months of this year versus the 7 months of last year. Job losses are up.
Somebody here says diverse portfolios are people who already have a lot of money. And that's exactly why real estate is so important. Because real estate is one of those places that you can over-concentrate but not take as much risk. So it's like real estate it's a glorious way, in my opinion, to build wealth.
Will happen at this point, but you need to see more than 25 to really start making a dent.
25 really isn't going to make that big of a difference, I think, to most people. I don't think you're going to go out and buy a car because 25 basis points less
Exactly.
or a house. Yeah, I just don't think that's going to be your driving factor there. So, you know, just like we have lags when rates are moving higher.
Someone says barrier to entry to real estate is too high. No, it's not. Do you have a job? You have a job. You can figure out how to buy real estate.
Waiting for the effects of lower rates to happen that really is going to give us the volatility and the concerns we have in this market. Yes, I think 25 basis points is what we see from the FOMC meeting in September. I actually think we only get one more this year, probably in December, and the market may have to reprice a little bit because right now they're saying 100 basis points.
Yeah, I was going to say, I mean, if we only get 2 and we have 4 priced in, it feels like, I don't know, some of the investors out there on the street are a little bit giddy because they fought the Fed. And they kind of won when you think about sort of the resolve to hold rates steady. Now you have the Fed and Jerome Powell all but saying we are going to cut in September and then keep cutting. What would the adjustment from pricing in 4 cuts to 2 cuts look like when you think about the S&P 500, the big tech names?
Yeah, so we're looking at an S&P right now after the pullback and then such a quick, you know, kind of whipsaw back to where we were. You're looking at an S&P that's tactically in an overbought position.
Woo! Big red candles out of nowhere. Holy smokes! No! No, we didn't make it to the line. Yo, what the hell? Yo, what the hell is this shit? No! The 476 line! No! It's been lost, my lord! No! It's 1 minute, Kevin. Yes, I know, but it's gone. And it's gone. Bro! What the hell, man? Get back up.
How should investors be putting this all together? Because even with the volatility that we've seen this summer, I mean, we're sitting on pretty healthy year-to-date gains. We're entering into what we know is going to be a pretty volatile season. And, I mean, do you just be happy with what you have? Do you just sort of sit tight through year ends?
Well, you definitely don't want to stand in way of the momentum of the market, and you want to participate in that upside. But I don't think that means that you have to be completely risk-on. I think it gives you the ability to be a little bit cautious in your approach.
A little risk-on. Anyway, okay, let's go jump on over back to CNBCs, and then we're going to go to the course member live. By the way, for course members, current allocations are updated. We've got, we're going to do some chatting this morning about a few things. We've got, let me write this down. I don't really care to listen to the White House, honestly. It's just going to be one-sidedness. But what we're going to do in the course live this morning is we have... Today, we're going to do Walgreens, Ulta, and Lulu. And so let's take a peek at those. And then we'll go from there. Yeah, but this... I don't want to listen to the White House. But this this loss here on the Qs is not ideal. And unfortunately, now you're at about 5-ish minutes here. Let's see if you can recover to that line. You really want to get back to that line. I think that's pretty important. What's interesting is as the market is selling off, you're actually seeing yields like TLT rise. So bonds rise. But yeah, look at that. IWM couldn't hold on. Tesla gave up on its run right there. And the data was good. Palantir's moving up. Affirm's back above its line. And BTC is up in the last 2 minutes here. So some bullishness there. So who knows, is this just a temporary little sell down here or what? And then do you get back on that uptrend? To be determined. But anyway, we have some what's it called to do? Fundamental analysis. Looks like Qs are going back to retest. Retest, baby. Retest. Anyway, we will jump on over into the course live and let's go do some fundy analysis. All right. Is that it? Is that all I got? I think so. All right, folks, thank you so very much for being here. We'll see you in the next one. I'm going to play the music now.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.
Little bit of a bounce there. Not much. That line is tough. You really got to break that 476 to expect it to be bullish. All right, thanks, folks. See you in the next one. Bye.